Welcome to Kaplan Professional's monthly economic update. I'm Dan Purves, and today we're speaking with Brian Parker, Chief Economist at Sunsuper, about the apparent breakdown in long-held economic relationships, synchronized global growth, and trade wars. Brian, welcome.
Pleasure to be here.
The RBA acknowledged in March that wage growth remains persistently low in Australia. What are the factors affecting this, and has the long-held relationship between economic growth and wage growth broken down?
I think broken down is probably too harsh a term. If you look at the underlying causes of why wages have really fallen short of people's expectations, firstly, I think lower inflation expectations has also played a part. But I think the big story really is underlying trends in the labour market. Yes, in the last 12 months, we've seen actually a resurgence in full-time employment growth. Full-time jobs have really recovered very strongly in 2017. But in the years prior to that, most of the jobs growth we saw in Australia was all part-time. So when you looked at measures of labour force underutilisation, when you looked at measures of unemployment and underemployment, those measures were a lot more elevated than the official unemployment rate. And I think that underutilisation has really kept a lid on wages overall. Now, if you look at more recent trends, those underutilisation rates have started to come down. It's still kind of early days, but given the usual lags, I think a reasonable assumption to make is that wages do pick up from here, that you do see an acceleration in wages over the next year or two, but it's coming off quite a low base.
February saw volatility come back to the markets on the back of expected rises to inflation. Has this altered your outlook for Australian and overseas fixed income over the next 12 months?
The short answer is not really. I think the really unusual thing about the volatility, the unusual thing was not so much the volatility we saw in early February. The unusual thing was the almost total lack of volatility we saw for the last 12 months. Where, if you look at US equities, for example, US equities went up pretty much every month during 2017. That hasn't happened for decades. So I just think the reaction to some of the wages figures we saw out of the US in early February, I think that says more about just how complacent markets have become rather than the data itself. Yeah, wages were a little higher than expected, don't get me wrong, but I think the market reaction was overblown. Now, in terms of the outlook for fixed income, yes, yields have risen over the last few months. Yes, yields are higher than they were, but they're not exactly all that high. I mean, it just means that future returns from sovereign bonds, future returns from investment grade fixed income are going to be very low. In the case of sovereign bonds, I think returns are going to be quite poor. Now, that's important to bear in mind. I think it is a frustration for a lot of investors out there, especially for retirees, when they look at the interest rates on offer and they look at the yields on offer and say, well, can't we do something about this? And the answer is no, you can't. The yields are what they are. We can't conjure higher yields out of thin air. And can we do something in credit, for example? Can you just increase your exposure to non-government bonds? Well, even there, a lot of the easy runs have been made. Credit spreads have narrowed quite considerably. I think it's too early in the cycle to actually be calling for spreads to widen dramatically. But the bottom line is those credit spreads have come in a long way. So future returns, even from non-government securities, are also going to be quite a bit lower than we might have previously expected. And I think we need to kind of accept that. Another important point from an asset allocation point of view, there's a limit to how much credit, how much non-government exposure you can ram into a fixed income portfolio. You want fixed income to provide defensive characteristics, especially during tough equity market conditions. And the more credit you have in there, in particular the more lower quality credit, then the more dangerous that becomes during a period of equity market turmoil.
In traditional asset classes, Sunsuper favours emerging share markets. What is the rationale behind this? And are there any markets that you prefer?
Look, that's a really good point. If we were sitting here about 12 months ago, 18 months ago, I would have said to you, if I look at the public markets, I look at the traditional asset classes, emerging share markets are probably the only place that we can find genuine value, where you can buy quality assets at decent prices. That was 12 to 18 months ago, but that was 30% ago. Now it's fair to say that our enthusiasm for emerging share markets has kind of waned a bit, given the value just isn't anywhere near as compelling as it was. returns. If you look at where we're finding value, well, it's kind of challenging at the moment. I mean, the feedback from our investment managers and our own modelling is that it's very, very tough to find asset classes, to find traditional markets that offer genuine value. If you look at the major regions, US equities, in our mind, look expensive. Not disastrously so, but they do look expensive. If I look at Europe, Europe doesn't look cheap, but at least in Europe, we've got some more earnings upside to come. We still see European earnings as still cyclically depressed, and we think there is upside there. Japan is kind of interesting. If you are prepared to give Abenomics the benefit of the doubt, in other words, if you believe that one of the key planks of Abenomics, in other words, getting returns on equity from Japanese companies, getting those returns sustainably higher, if you believe that that's going to succeed, then Japanese equities offer real value. If you don't, then they don't. And it really is, are you prepared to give Abenomics the benefit of the doubt, or are you not? That's really what it comes down to.
In the current economic environment, what is your view on alternatives, and are there any assets that are particularly attractive?
Yeah, it's a very interesting area. Again, let's just go back to the public markets by way of introduction. Public markets have had a very, very good run in the years following the GFC. Equity markets in particular have performed very, very strongly. But that's all in the rearview mirror. The key question for us, key question for anybody whose job it is to generate long-term real returns for investors, for super fund members or for advised clients, is where are real returns going to come from? Now, they're not going to come from fixed income. The future returns from fixed income are likely to be lousy. The returns on offer from cash are terrible. If I look at credit, yeah, I can do a little bit better in credit, but again, future returns there are not going to be high enough to meet the kind of return objectives that people actually need. Equities may deliver reasonable long-term returns, but if I look at the US, for example, US valuations are stretched, which means that future returns from US equities, and they are half the world, are going to be a hell of a lot lower than we've been used to and may actually fall miles short of the kind of returns that investors actually need. What that means is that from our point of view, we don't want to limit ourselves to traditional asset classes. We think the alternative space still provides decent long-term returns. And by this, I'm talking about carefully selected hedge funds, and I stress carefully selected, but also property, infrastructure, private equity. We're still finding opportunities in this unlisted space that are capable of delivering the real returns that members need. But even here, there's a caveat. If you look at the economic environment we've seen over the last 6-7 years, where monetary policy has been so aggressively expansionary, basically a rising tide has lifted all boats. So all assets have benefited from that, including assets in the unlisted space. So for example, if 5 or 6 years ago I looked at an infrastructure deal or a private equity opportunity and did the math and said, okay, well, what sort of returns am I likely to get out of this? Well, the deal might have given you, say, 15-16% per annum. You'd say, well, great, I'll take that any day of the week. Now, scroll forward to today, if I look at exactly the same deal, I might only be looking at 9 or 10. Now, I'll still take 9 or 10, don't get me wrong. It's just, it's not 15, 16. So even there, return potential has been compressed, but thankfully we're still finding opportunities in that space.
Thank you for your time today, Brian.
Great pleasure, Dan.